Brings us to item 4 on our agenda. It's Mr. DeRay, Ms. Worth, and Mr. Shantic. This is a nice segue from our morning conversation.
Actually, I'm going to step up for a sec. Take my seat, Ian.
Okay. I've asked the team to be brief, knowing the time is running long, but just to recap a little bit about what we learned from the group and then what ideas are coming forward, because we're setting it up for the May agenda.
Yep. And Chris, depending on how the afternoon flows, there's a couple of information items which I may push back to their reports as the green report, and there's one other report at
Mercy.
We'll see how the afternoon flows, but they're not mission critical that we get to them today. So there's a chance we'll push them back. Okay. All right, Mike.
Okay, well, I will be brief. We also are including Ann in this conversation, and I don't think that's the only other asset class that is affected by the strategies that were laid out in the morning session. But so far, the information that we've given to the board has been focused on the three primary asset classes that Paul and Margot and I represent. I think we heard what you guys heard, and of what the major issues were with that. We kind of do that already. Certainly, I liked what the big picture ideas they laid out, and that's something that we'll do. We'll be coming back to you in a future board meeting, maybe either May, June, or July, depending on the scheduling. And I think the paths of us kind of laying out what our advantages and disadvantages are, probably working with a general consultant and the specialty consultants that represent our asset classes for you. We'll do exactly kind of what they're laying out and also give you some of the history of things that we're working on. And collaborate with each other, talk to the marketplace, look at some of the facts with respect to the returns of these strategies, and come back to you in a future board meeting, which likely will be May, but may be June or July.
Okay. We're just going to go down the line and...
No, I think we're just...
Here for questions.
We'll open it for questions because that was an education session. That was what it was supposed to be, and we think everyone was educated.
Okay, good. Anyone have questions? Okay. I think Ms. Shee's going to weigh in. Okay. Betty?
Thanks, Harry. So I guess as we look at where we go from here, I was curious with respect to looking at some of our other asset classes besides private equity with respect to what we're doing on direct investments and GP ownership, like in real estate. Is that instructive? I guess I'm just trying to figure out, as we look at where we go with private equity and what we're already doing in other asset classes, are there comparisons to be made or experiences to be shared with respect to?
I guess I'd go back to what they said, and we're trying to point out, we think the path we're going to go down. Every asset class has different opportunity sets. Co-investment is an obvious one that was discussed, and that's a major one for private equity because the bulk of their investments are through funds. Whereas infrastructure and agriculture and real estate strategies, they're more open from a market standpoint to joint ventures and club deals. And we each have to find what is the best aspect to structure that would work best for us to accomplish our goals within the framework of our policies and state laws and whatnot. So we're at various levels along the way so far in our history here, and we'll take that into account of what our experiences are and where we are in the cycle and whatnot when we lay out a plan for going forward of what kind of strategies we want to pursue more of.
Okay, that's great. So, I mean, I think for me, what I guess one of the takeaways, and I really did find the prior discussion this morning fascinating, but want to kind of get back to the practicalities of what's possible, obviously. And to me, there are several hurdles with respect, or challenges, I should say, with respect to the whole issue of how we get the staffing kind of, the talent in place. And I want to just be sure that there's a deep dive into that. Obviously, we're working in a little bit of a constrained environment relative to civil service. On the other hand, I think there are some opportunities for creativity around how to get around some of that. But I feel like if we don't have that piece nailed down, it's a little difficult to think about what else is possible.
Certainly, we should have a conversation about that. We would probably task the consultants to kind of take an independent view of that as opposed to the staff commenting on that. But I will say that one thing that I do know that this staff has in common with what was mentioned there is a passion
Yes.
to move this organization in the right direction and and as we represent the teachers. So that's a good first step.
Great. Thank you.
Paul?
Yeah, I think, the session we had before lunch was very helpful for kind of creating a context and maybe as I was looking at this report, one of the, there was a check mark as to whether CalSTRS is doing this today, whether additional staff is needed, and was that a evaluation done in the context of thinking about what kind of cooperative ventures we might enter into, or was it just decided based on kind of looking at our own staff today and saying, we need more assistance here, for example, inflation sensitive, SMA, joint venture custom account. We're doing that today. It says though that we need additional staff skills. So is that to continue to do things the way we've been doing them, or is that anticipating working on new ventures? Didn't understand kind of the context in which that decision was made for all three asset classes.
On the inflation sensitive side, that's just looking at what we have now and what we're working on going forward. I'm anticipating that we're going to need more staff and skills that are more separate account oriented, dealing one-on-one with some of the general partners, and or if we have pension fund partners per se, those kinds of relationships. It's a different skill set than fund management. We'll always have a piece of that in our what we do, but it's a very different talent set. So yes, that's anticipating things moving forward, because that's the direction on the inflation sensitive side, particularly around infrastructure, agriculture, and timber, that we're trying to go. We want to be as close to the assets, I think, as it was mentioned here. Ashby mentioned that, or if not, it's in the book. That's the direction we want to go on the inflation sensitive side.
Margot, on the private equity, I was a little unclear because the row additional staffing skills required, the first 4 columns were check marks and the last 2 were yes. So I didn't know whether the check mark meant no or whether the check mark meant yes.
Let me take a look, Paul.
Because all the other ones, there was a check mark and an X.
Okay, the interpretation there should be that the check mark means we're okay, that we do have staff, and that
Okay.
that's not consistent with the other ones.
additional staff
Sorry for the
skills are not-
confusion
are
there.
not required. Okay,
Yeah.
thank you.
Okay, so just with respect to of real estate, we're a little further along in doing these direct investment models, and our experience to date is that because there's more decision-making along the way relative to like a closed-end fund, we need more people and skilled people to make those decisions and experienced people to make those decisions. So that's the path we've been going down. We have some history, and we can kind of show you the results of that history from a fee savings perspective and perhaps from a return perspective, although the data is short-lived because we've been doing this for about 8 to 10 years at this point. And so, yes, if we go more in this direction at a quicker pace, there would be a need for a higher number of personnel and in some level, at a higher level of personnel perhaps as well.
Thank you.
Joy? Yeah.
Thanks. So with the 3 tables that were attached to the item, I think what you said is if it's a check mark, it means that it's allowed, and X means that it's not, or there's an impediment. So I have a question, because like on the on attachment 1, which is for the table looking at real estate, under direct investment, it looks like it's not allowed by California law or by CalSTRS policy, but that we're doing it today. I don't know if I'm reading it the right way.
Okay. Because all the asset classes are different, we're trying to use a similar model to kind of show where we were in a simplistic form. We're unclear, and we didn't have a time to have a deep consultation with legal. It's unclear whether or not we can do some of the things within I can't remember the term of what we're governed under, the teachers' retirement law. And that is not our expertise. So anything along those lines, this is really more of something that we need to look into these issues and make sure that there's nothing in our way if we're going to go forward. And when we get direction to the board, if you want to go more forward in that direction, and perhaps between now and the next meeting, we'll clear that up. That we've decided that we're unclear of if there's any laws that are in our way or policies that might be in our way.
So in the item, it says that in May or June, staff may be working with the consultants to come back with a sort of a deeper dive, looking at all of these types of issues by asset class. So that's potentially when you'll have more clarity around some of these issues, and we can discuss
Absolutely.
what the range of possibilities are, or if we're precluded, if there are changes that we can consider seeking to make in order to allow some of these arrangements.
Joy, what I'd add, in May, we wanted to come back to you with, based on what we heard from the panel, what are logical next steps? And I think very clearly, we all heard, there's no one model. There's really, what we need to develop, I think, is the CalSTRS model. And come back to you and say, at a glance, here are our strengths, here's some of our characteristics. Here's maybe what the future could look like. That would be May. That would set you up for July for us to come back, and you've already said it as an investment committee, you want next year's investment committee objective, the big work plan objective, to include a further step of, okay, what is that business plan? What is the CalSTRS business model way that we would go about this? That would include the deep dive into what are the laws that we might need to change, and we'll have all next year to figure out what kind of staffing levels, what kind of rules, policy changes, and if any laws need to be changed in order to implement that. So it will flow on a natural progression. I don't think we'll get all the way to the finish line in May. We'll set you up in May and then get there, set the table in July with what we'll study for next year.
But it sounds like the deep dive will kind of be in the context of what we talked about this morning in terms of, knowing that there are some advantages that we have, other constraints that we have, what's sort of, the good short list of possibilities that we can look at more closely. Yep. Okay.
Absolutely.
Karen?
Okay, so my comments are just along the same lines as Paul and Joy. In looking at this chart, it was hard for me to understand what was going on now and what are potential things that we're going to be doing. So if possible, if you're going to bring this chart back again, could you have like a little legend as to what the little marks mean? That would be helpful.
Absolutely, and we'll have if we bring back something of this nature, there'll be a lot of dialogue around it in the write-up we give as well.
Good, okay, thank you.
Karen, I would, Chris back here, I would suggest look at INV 20. That really gives you an idea of where we are now and what's the natural next step for each of these groups. Paul's looking at custom accounts, Margot's expanding co-investment. Mike is doing custom accounts, and in some cases, we own small parts of companies. And that gives you an idea of shifting from a GP-controlled environment to more LP control. You could also look at the red, frankly, as being more simplistic ways to do it, and then it gets more complex on our side as you move into the green.
Anyone else on this item?
But I still need it.
I just asked Stephen and Alan, as this comes back with the staff in May or June, if you could help the committee begin to think a little bit more around the competitive advantages that we currently have and which we may have on a forward-looking basis. Because we have to start with with the realm of possibility, and then what are the advantages we have and how do we leverage those advantages to move forward. So if both of you could begin to think a little bit about that, would be great. Stephen? Yeah.
Thanks, Harry. Just one really quick comment, just to kind of set expectations on some of the numbers that were thrown out on the fee savings for internalizing more and more of the management of these asset classes. I just want to highlight that there's two reasons why these asset classes are expensive: infrastructure, real estate, and private equity. One is that there's a lot of profits. The other is that there's a lot of costs associated with investing in private assets. It's not like holding a public company that is more or less costless. When you source, execute, manage, divest of a private asset, there are a myriad of costs all along that value chain. Those costs you're going to incur whether you outsource this or internalize it. So it's not just compensation; it's a whole bunch of other costs as well. So I just wanted to highlight that there's going to be limits to how low you can create the costs in these asset classes.
Thanks. Okay, seeing no other comments on this item, we'll move to item 5, which is, Chris, this is your report, the Chief Investment Officer's report.
Take it away.
Yeah.
It seems like 2017 was so long ago with the market movement as of late.
I know.
But it was a spectacular year. So just to kind of go backwards a little bit, even though it does. Very busy chart. I know you can't read it, but what I'm pointing out is just the slope of that line. This is all the world markets, including the USA. Obviously, we're about half of that. But all those little lines and notes are some major event. If I had said to you at the beginning of last year that the Federal Reserve was going to raise interest rates 3 times, normally you'd be very cautious and say, well, it's probably going to be a choppy year for the stock market. If we talked about a very weak German election, a surprising French election, a president tweeting out all kinds of things, you'd be very worried. You wouldn't expect the entire world to have this wonderful climb across the board during this time period. Here's another way to look at it. This is different indices across the world. What's remarkable to me is if you look at that in US dollar terms, every market was up over 20%. And what I would highlight is the USA is actually one of the weaker markets, only up 21. Look at the emerging markets. EM is for emerging markets, 37%. Emerging markets in Asia, 42. Just remarkable returns. But currency mattered. The next line is pounds, and the far line is in euros. So you can see that if you were based in Europe, you've got strong returns, but you've got single-digit returns in a lot of cases. You only get double-digit returns out of a few. And then in the other bars, what's important there is the gray bar basically represents the USA. And you can see that we had strong returns, or pardon me, the world. We had strong returns, but there are some countries that really had remarkable returns across the year or around the world. Assets have grown. For the teachers in the back, at December 31, we hit $225 billion. We grew all the way up to about 230 a whole week and a half ago, but that was a week and a half ago.
Where are the balloons?
That was a long time ago. That was so yesterday. What do the kids say now? It was so 15 minutes ago. There you go. But yeah, 225 billion, that was the number that we'll show for December 31. So pretty remarkable and very strong return in the first half of the year. Here's the asset allocation. Obviously very heavily tilted still toward global stocks. I'll get into the mix there. What I would highlight is RMS was at 7.8% December 31. That has grown to 9% as of yesterday. And then we did have a cash position of about 2.5% going into the year end. On INV 37 is the performance at a glance report. Definitely one you can tear out and hang on to. We'll have a more detailed performance report in May with Alan Emkin going through the book. But I wanted to highlight for everybody just the returns over the longer term periods. For 30 years, the net return is about 8.7%. So yes, we're picking up the go-go years of the 80s and 90s, but you also are picking up 2001, 2, and 2007, 8. So two very severe recessions across that 30-year period. And then the 10-year. That 10-year number is really going to change dramatically when you drop off 2008. So you're going to be surprised at how the graphs change. And, right now it's only 5.5 over 10 years, but it's because it starts with a huge negative at the beginning of that time period. Look at the 5-year number. You guys remember that after we came out of the global financial crisis, most forecasters said we would have very low capital market returns. Yet shockingly, a 10% average return over these last 5 years. So pretty darn remarkable. And I'm pleased to say the 3-year number for the fund on a calendar year basis, not fiscal year, is 8.6. So well ahead of the actuarial assumed rate. We still have 6 months to go. And obviously now that's going to be a heck of a challenge. I was feeling very optimistic. We have 5 months to go. I was feeling very optimistic about 8 days ago, but yeah, the world changed on us. So here's an old chart of 2017. My gosh, a whole back a year ago. But look at the slope line. Here's a backup of the world, of looking at a longer time period. Look at the market from 2009. March 9th of 2009 was the market low. And you can really see the steady rise of the markets. What's remarkable is obviously the last year of 2017. You have heard me say numerous times, the rate of that climb, of that slope, is unsustainable. And obviously we started to see that very much so in this last week. Back away a little bit and look at this longer term. So we're going all the way back to 97. You can see the internet bubble craze and then burst. You see the rise in the OOs and the drop in 07, 08, how severe that was. But then really how remarkable the market has recovered during this time period. So even with the volatility we're now seeing, it really does fit, a choppy pattern, but it is not foretold that we're going to suddenly drop all the way back to the lows of 06, 07. The one thing I want to start mentioning and having you track a little bit is the yield curve. This is the curve of U.S. interest rates from basically 3-month T-bills, 7 to 10-year notes, and then 30-year bonds. The reason this is important is that it's normally positively sloped. Lower rates in the short end and longer rates in the high end. When that curve goes flat or inverted, that usually portends a recession. Not every time. There are times it's gone inverted and we've been fine. But it is something you're going to hear in the news more often. And obviously an inverted yield curve would mean that you'd have higher rates in a short-term time period than longer rates. Look at this if it's helpful to think of it in terms of CD rates, that you'd be able to get a higher rate for your money for 3 months than you would over 30 years. That doesn't happen very often right now, and these are obviously well dated because I printed these when the slides were due back on the 24th of January. But you can see how close interest rates are, that 2 years is only about a 2.11, the 30-year at 2.90, I think that's now 3%. The short end of the curve has moved up since June 30, and we'll watch that on a periodic basis, and I'll email you pictures about this curve. It's not so much where it is on the graph, but the slope. Is it positively sloped, or is it flat, or has it gone inverted? And those are the things to watch for. Here's the asset allocation where we are, very much within range. I would say that we started the market in February being basically 1% overweight global stocks. And I can answer part of Jane's question in the public comment, why did we sell down the ExxonMobil? It's because we're going global. So we have bigger allocations to non-US than we did before and less allocations to the USA. June pointed out to me that if you look at, it jumps out at you very subtly, but it's there, INV 32, the list of our largest stocks around the world. They are still USA, but look at the third from the bottom, Samsung, a Korean stock jumps up in our top 10 holdings for the first time. That really tells you we are truly global. And if you extended that list out, you'd start seeing UK names, Japanese names, even French and German names. So risks to pay attention to. This was a list provided by Eurasia, one of the groups that we subscribe to. On the left side are really risks that I've warned you about, have been very concerned about over time. But then on the right side are really risks that they said they were very concerned about. When they talk about accidents, they're just talking about human error, fat finger trades, or people flipping the wrong switch. But now they seem to have global context and potential risk. The comment about China loves a vacuum was the recognition that every time the USA steps away from a country, it seems that China's the first one to come right back in and take advantage of that and take opportunities to expand their business and their reach. But if you want things to keep you up at night, read this list every night, and that'll give you something to worry about. On my notes, I just wanted to make sure you are aware we had a joint legislative hearing on January 10th. Jack and I all spoke and made comments about divestment. I did some speeches with UTLA Retired and CTA. Just so you know, Loretta Trottenberger is not here. We heard from Denise that she's in the hospital, but want to tell everybody she's hanging in there. She was feisty as ever at UTLA Retired, I will tell you that. We're going to have a responsible contractor webinar in February with stakeholders and our real estate firms, so that fits into the hotel issues. And then one of the things a couple of board members asked us to do was take a look at standardizing our investment policies, making sure they followed a common format. So I've created a rapid results team that's going through best practices for policies anywhere, but then investment policies. And they will come up with a standardized format. And so we'll come back to you over time or as a big packet, say, hey, we need to put these in a common framework. So at least it makes it more readable, we hope, for you. A couple of things I wanted to highlight for you that we owe you a report back on. Make sure I turn to the right page. The first being firearm companies. At the last meeting, you asked us to look at the Treasurer's request to look at companies that retail or sell firearms that are legal in the state of California, or firearms that cause rapid fire, bump stocks, and things like that. We engaged a total of 12 companies, and I'm pleased to say they were very responsive. Virtually every company has come back and said that they do not want to sell those products and are not going to sell those products. They have been very responsive about the recognition of those kinds of problems. There still remains 2 companies because they have resellers that they're trying to double check and give us an absolute confirmation. One of the companies has multiple chains in multiple states. And I didn't think about it, but you reach up into places like Alaska, where there are retailers cover the entire town. They're still checking on those kinds of issues with the retailers or their locations in Alaska. But every company that we engage with has come back and said they do not sell those products and have no intention to, which is nice to get that confirmation.
Yeah, if I could, just because this is a matter of extreme importance to the Treasurer, I want to make sure that we give it its due. The Treasurer sent, as you know, a letter to the board, I think it was back in November, relative to a specific request. And that request was to divest from those firms that are either retail wholesale sellers of illegal firearms, at least the ones that are banned in California, and then added to that the accelerators that allow guns to fire rapidly. Commonly, I think one of the main products of that is bump stock. And so Chris and I had a chance to talk, and he said he was going to give his report. And I said, I truly appreciate not only the report, but also the fact that he's finding that at least the retailers that they're talking with seem to be inclined to not want to sell these products, which would seem to solve the problem, but I'm not so sure. So what I told Chris that I'd like to do, and it was actually included in the Treasurer's letter, to get an actual accounting of the firms in which we invest and whether or not they intend to sell this, what the size of the stake is. Again, I'm heartened by what Chris has shared with us, that the actual number may be much smaller than what we initially thought it might be in terms of a target of divestment. And so I would like to request that the staff return back to the board at the earliest opportunity to provide that accounting and prepare an item that would at least allow for discussion, if not for action, a divestment from those who we find out continue to want to sell these merchants of death that we all clearly believe should not be sold on the open market, and more importantly, that we should not have a role or a hand in allowing that to happen. So that would be my request on behalf of the treasurer, that the staff return with us with an actual accounting, and if we can, prepare an item that would allow us to have a discussion and possible action at a later date.
So noted, and I know Mr. King has a note there. We'll also put it on the, we'll agendize it for the next meeting. I'll work with staff to make sure that they can be delivered in that timeframe.
I appreciate that.
You're welcome. Chris, did you want to, is there anything else that you wanted to continue?
I realized the other thing I was going to report back was on the Pullman Hotel, and obviously we had that discussion about CBRE and their engagement.
Okay, thanks so much. I don't see anyone else in the queue. I'm just going to take a moment. Ms. Sheehan, would you please come up for a moment? Ann, would you please come on up? Ann, come on, sit down for a
I already
moment.
got teary-eyed one time today, Harry.
So, yeah, get your name there and everything. So, it's hard to believe, Ann. It's hard to believe. But 10 years ago, I met Ann Sheehan. And you know when you sit next to someone and you realize they're a lot smarter? That was the case. Rarely in my experience do you find people who have three characteristics, and Ann embodies all three of them. She has vision, she has the ability to execute, and she has integrity. And I've learned so much from you, Ann. You've served the teachers in this system extremely well. It's hard to believe that 10 years have passed. There was no Melissa in my life. There was no Sarah in my life. And during these past 10 years, you have helped CalSTRS to have a footprint, a global footprint. Global footprint. Think about that. A global footprint in the area of corporate governance. To be able to have that type of impact in one's lifetime. Very few of us get that opportunity. Very few of us get to be able to have a global impact. And you did not miss a beat. You hit the ground running and you knew where you wanted to go. You built a team. You've done an extraordinary job. On numerous occasions, I've emailed you just my little emails, 2 sentences. Keep fighting for the women because my girls are behind. They're the next generation. And at some point, I'll be able to talk about the impact that CalSTRS has had relative to women in corporate boards and who led that charge. Be able to have a legacy that will go from you to me to my children, and the ripple effect will be extraordinary. So we can't thank you enough for what you've done. The next chapter of your life, I'm confident, will be full of adventure. I don't see you, I may be skiing a little bit. I don't think you play golf. I don't see you resting for too long. Can't wait to hear the announcement, wherever it is, whatever it's going to be. But the directors of CalSTRS, your team, your colleagues, as well as the investment committee, want to present this to you, Ann. And we thank the people that made this possible. It says, thank you, Ann, for your energy, leadership, and poise, which has elevated CalSTRS as an active shareholder. As you always say, we're active owners of passive. And a model of corporate governance best practices on a global scale, securing the financial future and sustaining the trust of California educators, our mission. Presented February 7th, 2018, with special recognition, one of my favorite words, and gratitude on behalf of the Teachers Retirement Board and CalSTRS 933,000 members. Thank you, Ann Sheehan, for all that you've done for the teachers.
She was sitting on this board when I
Chris.
first started coming around here. She was here.
I could do Harry's echo and say, as we have said, Ann has had a fantastic achievement. For the board members, there were probably at least 4 to 5 years in a row when we would do our offsites. The one thing the board wanted to talk about when it met on the investment committee was corporate governance, corporate governance, corporate governance. And
Peter Renke.
even before Peter.
When are we gonna have dinner with
Even
the staff?
before Peter. We hired Ann, and it was controversial at the time, but she, and I echo what you said, absolutely took us from struggling with it to where we are a global leader and admired by other countries and sought after in so many other ways. So she has built a fantastic staff. We're going to miss a beat because you're not going to keep up with that same energy and poise, but we are going to carry the baton and carry on. And but thank you to Ann for all that she's done. It's been tremendous to work with her. I have one last little bit of housekeeping, which is, so you need to think about this at the February offsite, I will ask you, March. This is February. At the March offsite, I'll ask you, I can't believe it's already been 4 years, but PCA and Makita, their contract is due for a 1-year extension. You don't have to do much other than just say, yes, we want to continue that. And you can tell Harry won't vote, but we'll vote. We'll do whatever we have to do for public session. But that means, yeah, whatever. Yeah, that extensions are extensions. Yeah, they've been pretty efficient. But that means in 19, we will have to do an RFP. And so you'll have to decide, do you want dual consultants? How do you want to structure it? So just plant that seed for next year in your minds.
Okay, thanks, Chris. Seeing no questions, comments, we'll move to the next item, which is item 6 on the agenda. This is Ann and Brian Rice, PCA and Makita. This is ESG risk factor sustainability policy, an information request. So we can either approve it today or give suggestions for additional changes. Ann?
So, yes, good afternoon all. So this is the ESG policy that follows up the discussion we had in July. After, I think as Harry and some of the subcommittee members recall, we had had a discussion about moving our policy from principles-based to more rules-based, and should we introduce the concept of materiality. I think after the July meeting, there was a lot of, I think, what I would say misunderstanding is, was it going to change our process? And so at the instruction of the committee, we thought, well, let's take a step back, look at our current policy, which has been working well for a number of years, and see what we could present to you to retool the current policy instead of doing a rewrite that captures some of the concepts that I think the subcommittee wanted to capture in terms of trying to prioritize, but also doesn't move away from the long-time structure that we've had that I think staff and the stakeholders and others have been comfortable with. So what we decided to do is take a shot at our current policy, which you've got the history. As you know, we've had a statement of investor responsibility for many years here and have been one of the early leaders in this, and it's evolved over the years. And so what we decided to do, with the help of Brian, myself, and others, is just make a few tweaks to the current policy, come back to you and say, does this seem to capture what the committee was looking for post our July discussion? Some of the changes that we have made is we made a few tweaks to make sure people understand it covers the entire portfolio. Because when the policy was first adopted, it really seemed to cover more of the public equities. And we talked about holdings in companies and securities and corporations. This way, we sort of changed it to say all our investments in turning in, including those. We also just made a few tweaks in terms of making sure that it reflected it covered the index as well as the other, and the processing, the steps that we would take to go about the engagements and carrying out the ESG policy. And then the risk factors that we've had for so many years, the 21 risk factors. It may be hard if we go along with this because we won't have 21 anymore. We're going to have a few more. But we added a few more risk factors that we seem to sort of reflect the developments in the market. And really, especially on the environmental side, as you see, we've sort of broken up the environmental risk factor into ones that are a little more specific in terms of climate change. I think Jane had made the reference before. We had done that before, but it was under the environmental one, and we decided it would be helpful to sort of break that one out because of the work that we're doing with TCFD and some of our other issues. And then the resource efficiency. I think you know over the past few years, Brian and Travis have done a great deal of work on water resource efficiency, energy efficiency. So we thought it would make sense to break those out. And then the other one that we added was the respect for Indigenous peoples' rights that came up during the Dakota Pipeline discussion last year. We thought it would be helpful to also add that risk factor to the list. So this was an attempt to respond to the request from the subcommittee, but maybe not completely rewrite the policy that we've had, but to add a few of the elements that the committee was looking for, and to bring it back and see, is this the direction you would like to go, or do we want to go back, and try and rewrite it again, or what was the desire of the committee? Mr. Rosensteel, I know you had given us some comments the other day. I had, so I don't know if you want to bring them up with the committee members when we get to that discussion. And then I think Mr. Rosensteel was, I think, the only one that we had gotten any feedback from in terms of, is this the direct approach? So I want to make sure, is this the preferred approach for the committee? Is this a way to sort of address the issues and the questions that we had back in July as to what our process and procedure is for carrying out the 21 risk factor and the ESG policy?
Thanks, Ann. Brian, was there anything else that you wanted to add right now?
No, I would just point out that around, there seemed to be some reluctance about the 21 risk factors, and it's been such a well-established thing for us. And really what we thought was that it's difficult to limit ESG risks to just 21, and depending on where you're invested and what you're invested in, certain risks are applicable or not. So we thought it might be better just to call them CalSTRS ESG risks, maybe rebrand it, and then we can, they don't have to stay 24, depending on, you can revise them, raise them, lower them, change them.
They were 20 at one point.
And also, too, I think it challenges more when we're engaging to say, look, we think ESG risks are important, but we're not limiting them. A lot of times I've found that particularly maybe managers sort of check the box and say, well, CalSTRS has 21 risks. Okay.
Right.
Now it's more like, well, what are the ESG risks you think are important? Maybe there's not something that isn't necessarily on our list.
Helpful. So let me. There's some folks who have queued in. Do either of the consultants have any feedbacks or thoughts on the policy as written yet? Now, no.
Not at this point.
Okay, great. So we'll go to Betty, and then Sharon's after Betty. Betty?
Great. Thanks, Harry, and I really appreciate the work here, and actually think this version captures the current approach to ESG in our corporate governance work, and I would say that a more comprehensive revision probably can come later. And I particularly like the increased focus on climate change and resources, and we're just reading today about effects on the water supply, not just from fossil fuels, but also chemical and fertilizer plants, operating plants throughout the country. So I think in terms of bolstering our efforts on corporate engagement, it kind of helps to give that aspect some focus. So I really support this, and thank you for also highlighting the indigenous people's rights. And on that front, aside from just the Dakota Access Pipeline, I know we've started to get approaches from tribal communities about actually being recognized as independent sovereign nations for the purpose of maybe even engaging in investment opportunities. So, thank you.
Sharon?
I would second all of Betty's comments. I mean, I appreciate the additions, and I love where we're at in the policy for now. I think my only question, I liked your rebranding comment, Brian, and that was my question is, so now moving forward, we as an entity will refer to our ESG factors when we talk about this. And because I know when I was reading through the other investment items, we still refer to the 21 risk factors. So I'm assuming kind of from once this is approved, moving forward, we'll just say like ESG factors and use that language to kind of capture the spirit of our ever-evolving dynamic list of risk factors. Is that
Yes,
accurate?
I would imagine there'll be a bit of a transition. I mean, the 21 risk has been around for such a long time, but we'll have to just keep.
But it's, I
I think
it's
ESG
really
risk factors is
appropriate.
more effective.
Agreed.
Thank you. Dana? How's that? Should be.
One of them came on.
Yeah, you're on.
Alrighty, so Ann, I'm sorry that I didn't get a hold of you earlier, but investments was one of the last things I read, so I apologize. I like this better than what we were trying to do prior, and I like that we're going away from the 21 and just making it the ESG risk factors. I think that makes a lot of sense. I think that gives us a lot of flexibility within those risk factors to have the conversations that we need to have. There are some grammatical things that I hope that we clean up as we go through it. And any of my suggestions, like there's a place where we talk about solely in a couple places, and we don't need the redundancy, and we can clean some of that up. So if somebody actually moves to approve this today, I'm not going to have I think we can take care of that still within that parameters. But I do have a question on the respect for indigenous people's rights. And I'm really not quite sure how to put it. And I know what we were trying to wrap our arms around. But it seems to me that if we're talking about long-term profitability from operations activities and business practices that do not adequately respect the cultural value and ethnic identities of where we're doing those investments, I'm not so sure that's just indigenous people's rights. And so I just want us to think about that as we move forward. I mean, it's definitely the population that's living in the areas and territories of where these things happen, I guess is a tactful way to put it. I'm just not sure that it's only going to be indigenous people that are going to be affected, that we might have some issues with. And so I'd like us to think about how in the future, I don't want to hold this up by trying to brainstorm that now, but I think we can massage that a little bit. And I think putting the thought of dispossession with materially degrading lands, territories, or resources, those are two pretty disparate thoughts, and maybe they should be separated from each other. It just kind of reads weird to me, including those. And then I think that actually for the business part of that item is it for me, but I wasn't quite sure how the resolution that follows the item is changing what we're doing with the risk factors, I guess. I don't understand the correlation between the investment resolution and that item. So if you can explain that to me, I'd really appreciate it.
It got tagged on.
It's-
The resolution
this
comes
was
at
not
the
on.
end, very, very end of the investment policy. Because the ESG policy is attachment A, the resolution is technically attachment B, but it's not called that. It's a legacy document of the 1970s that I have not been able to figure out how to make disappear, but this is literally the old legal list resolution. So you're right, it just got included because it's part of the set, but it doesn't belong.
Is in the IPMP.
All right,
Hitched a ride.
already. Thanks, I appreciate that.
And we will give, Dana, we'll give some thought, because I think you raised some good points on the indigenous peoples. We wanted to add that in. I think you make a good point about sovereign people, and the point that you made, Betty. And the, maybe separating that out. So if it gets approved, we can come back and see if we can tweak that a little bit, because it was an attempt as we looked at, we were doing some of the engagements, what were some of the things we wanted to look out for with regard to those issues? Okay.
And I don't want to hold it up and massage that now, because I think it's important that we get this
And
included.
you were right on the grammar, as we've said, when you write these 6 and 7 and 8 times, it reads like you think it reads.
Absolutely.
And then you're like, oh, I think I missed the spelling there a little bit.
I went back and read my note to my substitute.
Paul? Thank you. So I appreciate this, and I like the general approach. I think, adding to the list of risk factors and then putting them into context, but not saying that this is the number that is cast in stone is a good idea. The concern that I have is that over the last several years, as we've talked about ESG factors and ESG, which we've talked about a lot, and we've had a lot of people come and speak to us. We've had people from SASB more than once. We've had people from Ceres. We've had a lot of conversations, and what I think has been important to our developing understanding of ESG factors is that they're credit factors, that they don't stand apart from our credit analysis. It's not like we do credit analysis of an investment and then we look at what they look like from an ESG standpoint. But ESG factors are fundamental credit factors. And so what I think is missing here is that recognition. And I think in some ways, the way this is written now kind of undercuts the importance of ESG. Because, for example, there's a sentence here, and all my comments have to do with the third paragraph. And I will offer some revised language for it. But there's a sentence
the
there.
INV page. What page?
Oh, I'm sorry.
It's okay.
INV 51.
INV 51.
Yeah.
Okay, thanks.
Of the new version of it.
Yep.
So that there's a sentence there that says, it's important to note that fiduciary standards do not allow CalSTRS to select or reject investments based solely on ESG criteria. And I actually think that's not true. I mean, if ESG factors suggest that an investment is a very bad investment from a credit standpoint, then we are perfectly in our rights to reject it on the basis of ESG factors. So what I want to see here, and I think it's really essential because I actually would not be able to support this the way it's currently written, is a connection between ESG factors and our credit analysis, long-term credit analysis, and incorporation of the concept of materiality. Again, we've always talked about materiality, and the concept doesn't appear anywhere except, I think, in the newly added risk factor about indigenous peoples. So, I would take that third paragraph and I'll just read it. We don't need to act on it now, although if people would like to, we can. But I would read it to rewrite it to say, consistent with its fiduciary responsibilities to our members, the board has an obligation to ensure that the corporations and entities in which we invest strive for long-term sustainability in their operations. Managers of our investments who do not strive for sustainability jeopardize achieving the long-term expected rate of return we expect. CalSTRS incorporates ESG considerations into its analysis of the riskiness of its investment decisions and its ownership policies and practices to the extent that ESG factors are material to the long-term success of an investment. So I would like us to consider language like that, or perhaps alternative language, but language that incorporates a stronger connection between ESG factors and credit factors, because ESG factors are long-term credit factors, and the concept of materiality.
I'm going to take Dana next, and I'm going to address your suggestion, Paul. unless others want to weigh in after Dana. But we'll address your recommendation. Dana?
I was just going to suggest that if we're going to consider the paragraph that Paul's talking about, that we table this until after our next break, so we can get a copy of the language that Paul's suggesting, and we make the decision then.
We're almost in sync, almost there. What I was going to suggest is that Paul's language be sent to the consultants and to the staff for them to see it, to review it, and come back. Okay. What I don't want to have happen is for us to wordsmith it here on the dais. So it's a full paragraph, and the consultants have seen it. Does anyone have a strong opposition to what Paul's suggesting be amended to that? Is there any strong opposition to what Paul's suggestion? Is there a reason why we shouldn't or can't adopt what Paul's suggesting? Because I've spoken to Paul about it, and I essentially said I'm agnostic on it, and I could live with it or without it. I personally need some guidance. So I'd like to hear from Alan or Mika.
I believe it strengthens the policy, and I do take an exception. I don't think it's a credit issue. I think it's a fundamental issue. It affects both debt and equity. So I think using the word fundamental addresses that, but that's the only comment I would have.
So you think it would strengthen the policy?
Linking it to performance, I think, is crucial because you wouldn't be doing it otherwise.
I would broadly agree with that. I think that linking it to performance eliminates the need for stating that it cannot be the sole criteria for making the investment. So it ultimately then solves the problem, I think, in slightly more eloquent language, which I like.
Okay. Does council want to weigh in at all? It's a policy. Is there anything that we should be sensitive to from a legal perspective?
Well, given the fact that this is the first I've seen this, I think Harvey and I are the language sounds great. I think maybe clarifying the use of, and I haven't seen the language, but the credit factors, the use of terminology like credit factors. And so, I understand exactly what Mr. Rosenstiel was saying, but I want to make sure that we're clear on what that means.
Okay. Does any of my colleagues want to weigh on this specific issue? Because then we can deal with this procedurally so we don't get tied up here too long. Sharon, were you going to speak on this specific point?
On the specific point of?
Paul's recommendation?
Yes.
Okay.
So
Go
a couple
ahead.
suggestions. One, I do think we should all have a copy of it in writing before we make a decision, which is your suggestion and Dana's suggestion. So I think I would have more comfort just being able to look at it visually and look through it. And then I guess the only other question I had is, and I don't know if the consultants can do this on the fly, but could you compare and contrast what we have in front of us and what Paul's suggesting in that third paragraph and be able to sort of say what the difference is, or when you say it strengthens the policy, could you be more specific in the way that you think it does that? Or Ann, however you want to ask.
We have this policy in place now, and I know, Harry, you'd love to move. We can bring this back in May so that everybody has it in front of them. We could work on the indigenous, because we're not in.
There's we, is that a we?
Yeah.
Special contract, special services.
On the website, as I'm in Hawaii or something, yeah. But I mean, and that's why I asked Brian, because he would, they can bring it.
What I'd like to do, what I'm going to suggest we do, is that come back in May, have the policy that we have in front of us here, and then have a second page, a second part of the policy that has this, and then a recommendation from the staff and the consultants, and as to why we should adopt one or the other, rather than us wordsmithing here,
Right,
asking for
that's what I
Brian and Harvey's comments.
No
And
rush to, but
Yeah.
bring it back so you
Let's
have
get
a
it
clean
right.
copy. We can work on
it's the least we can do for you, Ann.
It's a parting gift.
I'll work on the language with Brian before I leave on indigenous, yes.
You know, having us wordsmith this is really a better
And
gesture.
we
at
have a
this
good
point.
policy now that's working, so it's not going to prevent us from doing anything over the next the proxy season. So it's good.
I think procedurally, it's much better to do it. Paul, thanks for bringing this to our attention, and then we can have it come back with a recommendation from the consultants, and legal can look at it. And if it strengthens the policy and is a better policy, thanks for bringing it to our attention, Paul. And if it's not, you guys, you can let us know why it's not. Is that okay, Betty? Do you want to jump in? Yeah, go ahead, Betty.
I have one kind of word thing.
Sure, yeah, please.
Actually, I'm fine with the policy. It actually was not exactly how Paul described it, because I was not in favor of linking it to any kind of credit analysis. But I think we just want to revisit what material means in this context, so, as we look at it.
And last voice on this, Dana?
So Anne, congratulations, you might not have to look at this again. Brian, on the other hand, can we massage some of the other things we were talking about earlier before we bring it back?
Yes.
I'll be in contact with you, thanks.
Okay, thanks. Okay, so
you.
we'll come
Good
back.
job, Mr. Chair.
Alan, did you want to? Oh, okay, very good. Thank you. Thanks, Paul.
He's moving on, Harry, he's moving on. Well done, boy.
Item 7 is a review of the responsible contractor policy, and in the materials is the letter from Treasurer Chung dated September 8th, 2017. I believe it was in the November meeting, we asked PCA to respond to the request of President Chung. That was a Treasurer Chung. Wishful thinking, maybe. Alan, it's you.
Okay.
There's no reason for me to read the letter. What I'm going to do is try to summarize the key facts. The responsible contractor policy has been in force for a number of years. It's been amended over time. It reflects this board's and this committee's commitment to fair labor practices. And it was designed to be most impactful on those assets where the system has control. And it's very important to underscore where you have control. Realistically, there are only a limited number of areas where you have enough of an investment on your own where you can control the decision. In most of your partnerships, you're a limited partner, and by definition, that limits not only your liability, but it limits your ability to impact decision-making. We detail that in a limited way in the body of our letter to you. The issue that, in my opinion, the treasurer wanted to focus on was the potential applicability of the policy or the intent of the policy to contracts outside of the investment arena. And it is our belief that the spirit language, which currently is specifically stated in the existing policy, could in fact be used subject to review by your administrative people and legal across the board as a criteria in your decision-making on contracting. And that's the policy decision for you, but that's really the intent of the letter.
Thank you, Alan. Steve.
Yeah, first let me, thank you, Harry. Let me start by thanking both the staff, but in particular PCA for the memo, which I think does encapsulate, for the most part, what the treasurer is trying to achieve. As many of you in this room may know, we spent a number of months with CalPERS over the last year trying to encourage them to adopt similar policies, and they've been willing to do so, and I can describe in some detail what they've done. But I want to be clear on two things. Alan's right on this, on the part as it relates to non-investment contracts. We believe, and the treasurer believes strongly that the institutions do in fact own those contracts. They have the ability to influence the behavior of those folks who are on the other side of that contract, and therefore, at a minimum, having a placeholder within the list of conditions for contractors to follow, and it can be a whole variety of things. Some of them may be appropriate, some of them may not, depending on the type of service that we're acquiring. But by and large, keeping with the spirit of RCP, and in particular on two issues, one of those being organizational neutrality, but also on paying a prevailing wage. We believe those things are the types of things that should be front and center when somebody gets a contract from CalSTRS in a non-investment area. We think it's very important to have that stated clearly, and then to try to hold them accountable to that standard. The second issue, which Ellen didn't touch on, but it is referenced here in the memo, is in the area of private equity, where we do have an ownership interest, and I know that's been very rare for this board and for this organization, but where we can control the behavior through our investment situation or position, we should try to do so in a way that is thoughtful but upholds the principles that I stated, which is, again, organization neutrality, prevailing wage, and other precepts within the RCP policy. And as we talk about going more to direct investing, I would think the opportunities are going to arise more significantly for us to have that type of leverage. And so I want to at least point out that there's going to be a greater opportunity, I think, to influence the behavior of folks in these areas. And so I just want to suggest that as we go further in the investment side on private equity, where we do have an ownership interest, typically categorized as 50% plus one, we should try to exercise that role. So all that being said, what the treasurer is asking for is a shift in at least just what I would consider to be a subtle change in policy that directs that type of language in our contracts and says that we expect people to follow these precepts and come back to the board and have us adopt that, both for non-investment contracts as well as those investment contracts where we hold a majority interest.
Steve, on its surface, the two principles that the treasurer is looking to address, the organizational neutrality and the prevailing wage.
Right.
Those are the two principles in which...
Those are the most significant ones within your RCP and within the RCP that's being put forward by, and so at a minimum, I would say those are the two things that we have found have sometimes been wanting when we look at these contracts and see that, in fact, people have found a way not to endorse those types of things. What got us into this, I'll say situation, what perked our interest was hearing from folks similar to from who we heard today, where you had an employer who very specifically was expressing an opinion about organization. And we're not telling them that they have to endorse unionization. We're just saying, stay out of it, let the workers decide for themselves whether in fact they want to do so. And so we believe that sending that message loud and clear as part of our contract provisions, especially in non-investment contracts, is a very important thing to have. And I've already shared, I think, with Chris, what we have in the treasurer's contracts. We have similar language, and we've gotten similar language in the PERS contracts. And so we're happy to share that and hopefully go from there.
Yeah, if I may, what I'd like to do is I would like to be able to have, because on its surface, based on the information I have before me, that sounds like something I would want to be able to support.
Sure.
At the same time, I look at, our legal team and a lot of resources that can help educate me. What I would like for me to be able to have in order to responsibly be supportive or not be able to support something is have an opinion expressed to us that says, this is possible, here are the risks associated with it, or this is why it's not possible. And in an ideal world, in other organizations similar to CalSTRS, that's doing exactly what the treasurer is asking. Where's it being done? How's it being done? What's the cost of doing that? And I think probably Mr. Lieberman would have to weigh in as well on some fiduciary responsibility as well. So I'm not looking to push this off into the distant future, but I don't want to wholeheartedly embrace and say, yes, we're going to direct staff to do this right now. Go do this.
No,
without the appropriate.
And just to be clear, I wasn't asking for action today. I appreciate
that was my enthusiasm.
Your methodical approach is eminently reasonable. But I would hope that we wouldn't. I think this is well-trod territory. I would hope we wouldn't take too long to come back to the board to see if we can do something. And out of due respect for legal counsel and the procurement folks at CalSTRS, I want to make sure that we give them every opportunity to say how it could work best, and certainly weigh into the board as to what they believe is the right thing to do.
Terrific, thank you. Betty?
Thank you, Harry. I wanted to, I agree with you. I think I think the goals are laudable, but I also want to be sure that we're doing our diligence around this. And I thought I'd throw out a couple of questions because I want to just be clear exactly what we're talking about with respect to non-investment contracts. So extending the RCP neutrality clause to non-investment contracts, I would like to get a flavor of what those contracts are and how a policy would be implemented to those contracts. And then with respect to private equity, and I don't know the answer to this, I probably should, but whether the current private equity policy already includes the RCP or whether that would need to be added. And I don't know if that's the case. Also looking at any practical effects of having such a policy added to the private equity policy, what that does in terms of making perhaps CalSTRS less competitive in the asset class. I mean, there are going to be effects associated with this, so to the extent we can comment on that. And I think I just want to recognize kind of the body of law that's already in place around some of these issues, and so maybe this is more for Fiduciary Council about whether this board taking action, given the current state laws that are kind of governing on contracting, and also provisions of the National Labor Relations Act, kind of how do we square all that? Because there's a lot of kind of factors in play, and so I just want to be sure that we're real clear about what the impact of this policy is supposed to be.
Thank you very much, Betty. What comes to mind is the duty of loyalty, right? My duty of loyalty to the trust and to the fund and to the beneficiaries of CalSTRS. And by making decisions, to what extent is that duty of loyalty enforced, enhanced, or compromised? And what's the cost of doing that? So that's probably a lot broader than that. I think, so I think we need some information, and we need someone to weigh in with us relative to how we may or may not be able to advance and expand what's being requested. And to do it, I think Steve, do you think within the next 2 months or so?
Yeah, I think if we could do it by May, I'm sorry. If we could have something by May, just as a board item, and I would welcome if staff had a particular perspective on this. I'd welcome to, because if it's in the way in which we'd like to see it, we're obviously going to be supportive. If it's not, we can at least prepare for that possibility. But again, I don't see it as something that should be divisive. I think we can talk through these things, and I think Betty's questions are appropriate ones, and I think there's good answers to all of them. So
yeah, no, I think this is actually a great opportunity for us to address some pressing issues that I don't think are going to necessarily go away. And the more information that we have relative to what we can and cannot do in this role, I think will be helpful, shed some light on it. So, time's up. All right, thank you. Anyone else? Okay. All right, thank you, Alan and PCA for the memo and the work on that. Item 8 is the review of investment belief number 8, which is the alignment of financial interest, which ties nicely to this morning's conversation with Ashby Monk, et cetera. Alan?
I think it was over, Mr. Chair, members, Alan Emkin, PC, I think it was over 2 years ago that we started the investment beliefs process.
It was, April.
I think it was November of
We're bigger than Titanic.
16. I could be wrong on that, but I was younger then. That I can promise you. And this process has in fact contributed to the aging process. And it is my hope that either you go up or down with it today and let it be over, let it rest. That's not professional advice, that's personal advice.
Whatever we can do to help, Alan.
So there was one issue that was on the table that was brought to the committee by the stakeholders regarding alignment of interest. A couple of board members and outside people were very interested. A series of iterations of the policy were drafted, discussed, brought back to the committee, and we were given direction to give it one last shot. The one last shot is reflected in our memo. It is very, very specific. To the best of my knowledge, the stakeholders support it. There's nothing within the body of it that in any way, in my mind, does anything more than reflect current practices. It just memorializes it, because I think these are currently true. But it heightens it. It brings it to a higher level. And I urge you to adopt it. Or don't adopt it, but just make a decision.
Just get it over with.
I get paid either way.
Thanks, Alan. Sharon?
I'd move adoption of belief 8.
Second.
Okay, it's been moved by Sharon to adopt investment belief number 8, the alignment of financial interest between CalSTRS and its advisors, which is on INV 72. It's been moved by Sharon, seconded by Dana. Discussion. Steve?
Yeah, I'm only going to vote for it to give relief to Ellen. And I would just say, the last time I sat in this chair for any length of time was I think it was in May of last year, and you guys were still discussing item number 8. So the investment belief number 8, and I was surprised to find it here when I got here almost a year later. It's still here, so I would certainly support it.
Thank you. Thanks, Steve.
We are thorough. We are thorough.
Betty? Oh, I'm sorry, would you wait back in, please, Betty, and I'll write you back in. There you go.
I support the belief. I guess I'm just questioning what the difference between this belief is and belief number 3, which acknowledges the long-term benefits of managing investment costs. And maybe some redundancy is okay, but if there's a difference, I just wanted to understand it.
Madam Controller?
Yeah.
The previous one really addresses fees as opposed to alignment of interest, which is a much broader scope and transparency.
Okay.
And you could say it's piling on, but I think it's a positive piling on. If it brings to the fore that this is important to you as an institution, that the interest of the people you do business with is clear in contracts and is consistent with your goals and values as an institution, I think it's worth having.
Okay, that makes sense. And thank you for restricting the alignment to financial interests. I think that makes it very, very clear. Okay.
Seeing no one else in the queue, it's been moved and properly seconded to approve investment belief number 8. All those in favor say aye.
Aye.
Opposed? The item passes. The beliefs have been adopted. At the next meeting, you'll bring the whole set back.
Oh, yeah.
Thank you so much. Thank you.
You made me a happy man.
Thanks. Doesn't take much, huh? Okay, so we'll take a 10-minute break, and we'll come back in 10 minutes. Thanks, everyone.